Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with this Thursday expert, Mr. Jonathan Twomley. How you doing, sir?
I'm well. How are you, Michael?
I'm doing well. Something that I don't think we've ever talked about that I think I just wanted to put out there for investors is there's this term called accredited investors. And then obviously the flip side of that is non-accredited investors. Can we just kind of talk about what it is, why it's important specifically maybe in syndications? Just give people a color of what that is.
Yeah. So accredited investor, it's a little bit of a misleading term because, and I've had people ask me like, where do I go to get accredited? Well, there's nobody who's accrediting.
Yeah, you don't get a stamp.
Right. Yeah. And I don't know why they picked that word when they wrote the legislation. They maybe should have just said qualified investors or something like that. But what accredited, there is a definition to meet accredited investors. Actually, there's about 10 different categories, but most of them don't apply to people, right? Some of them apply to companies and whatnot. But the ones that are relevant to investors, and first I'll tell you what the definition is, and I'll tell you sort of the background of this and why this is important.
Please.
So the definition is either you made $200,000 in personal income last year, and you expect to make it this year again, or $300,000 as a couple, right? So you can combine, if neither of you makes 200,000, but you make 300,000 together, then you also qualified as accredited.
Okay.
And then the final category that's relevant is $1 million in net worth, excluding your personal residence, right? So you're not allowed to put your personal, it's like if you live in a city where, you've had a lot of, appreciation over 20 years, but most of your wealth is tied up in that doesn't count.
Okay.
Right? A little bit arbitrary too, because like if you go and you take like a loan on your property and you stick all the money in the bank, right, and then you exclude your personal residence,
that's a good call.
So the debt and the equity doesn't count anymore. Now you're accredited. If you put it in cash,
that's a nice,
because
I
now
never thought of that.
Now you've got $1 million in the bank, right? Or whatever. So
that's funny.
It's kind of dumb. But also the legislation was written long before we had like this fantastic house price appreciation. It was, this is actually very old legislation, goes back to the original securities legislation that was passed during the New Deal in response to all of the rampant Wall Street fraud that was going on in the 1920s. Okay. And so when the Roosevelt administration started to regulate securities, and they had never been regulated before, except for like on the state level, they have these state blue sky laws, which still are in effect. Actually, most people don't really know that states also regulate securities. But the Roosevelt administration passed a bunch of securities legislation back in the 1930s, and to regulate essentially IPOs, right?
Okay.
So public offerings of securities became regulated, and with all this disclosure requirements, and it's very onerous, like what you have to disclose to do a public offering. But they also recognize that there were a lot of instances where somebody might want to raise money, but it just didn't make sense to do a public offering. They wanted to do what's called a private offering to just, a certain number of investors. And so what the legislation allowed for is for people to do private offerings. They wouldn't have, so the default is an IPO, right? If you're issuing a security, you must do an IPO, except if you fall into one of the exceptions. Okay. And one of the exceptions is private offerings, and there are a whole bunch of different varieties of these as well. But the main one that syndicators use, there's sort of two main flavors. They both fall under what's called Rule 506 of the securities, of the rules that implement the securities code, right? And these are SEC rules to kind of set out how these things should be done. If you do a private offering under Rule 506, then you do not have to register. You do not have to conduct an IPO. Okay. Right? You still have to register it with the SEC, but that's literally like, there's a form you fill out, you send it to the SEC, said, I did this private offering. That's it, right? But you do the registration. You also have to register with all the states that are involved. But the two main 506 rules are 506B and 506C. Those are the ones that most people use, and they have there's slight nuances between them. And this is where sort of accredited investors come in, because you have to be accredited in certain cases to take part in these, right? And so 506B requires that the issuer, so let's say I do a syndication, right? In a syndication, the investors do not actually own real estate. What they own is a piece of the LLC that owns the real estate, right? And so that is a security, right? I've sold them a security. I've not sold them real estate, right? So since I'm issuing securities, just like a company, when it goes public, it issues stock, same thing. I'm issuing stock, except that it's called an LLC membership interest rather than a share of stock, but it's the same thing. It's the same thing.
All right.
And so who can participate then? Well, in a 506B offering, I can only take that, I can only offer that to people with whom I already had a pre-existing substantive relationship, right? So I can't go on Facebook and say, hey, I've got a deal, right? I can only go and like call, go to people that I already know and say, hey, I have a deal, right? And within that group of people, they must either be accredited or you can have up to 35 what are called sophisticated investors, which is a really unhelpful, very vague definition, but essentially means somebody who's like sophisticated enough to understand the risks involved in this, in investing in this thing. And that's all the guidance there is. There's like no guidance at all as to what that means, right? But you're under kind of an obligation to, as the issuer, to like kind of understand that they are sophisticated. And that's why you need to have a relationship with them beforehand. You're supposed to know them well enough to be able to make that judgment, make that judgment call that they are sophisticated. And if you can have up to 35 of them in a 506B offering and an unlimited number of accredited investors, and in a 506B offering, because you have an existing relationship with them, and again, you were supposed to know them well enough to be able to make this judgment, but they don't have to prove that they're accredited, right? They can self-certify. So if you have that pre-existing relationship, because the idea there is that, okay, somebody's going to say, yes, I'm accredited, and you know them well enough that you can take their word for it. So you can say, oh, okay, this guy, is not flipping burgers. He has his own accounting firm. So I'm going to take him at his word that he actually has $1 million net worth, or that he actually makes $200,000 a year. Right? Okay, so that's 506B. Then you've got something which is newer. It passed as part of the Jobs Act, right? To make it easier for people to raise money, you've got 506C, sorry. And 506C says you can offer your deal to anybody in the world. Well, I should say anybody in the US, not anybody in the world. There's not securities problems with foreign investors, but there are tax problems. So I don't usually offer securities to non-US people unless they have a US entity through which they're investing. And that makes the tax problem their problem, not my problem. So anyway, you can, under 506C, you can offer your security to anybody in the world. You do not need to have any kind of pre-existing relationship with them. So you can blast it all over Facebook. You could take out an ad in the paper. You could walk up to random people on the street, whatever you want to do to try to sell this deal. However, you cannot have any sophisticated investors in it. You can only have accredited investors, and they must prove it, right? So they have to go to some kind of third party, like either their CPA who's going to sign a letter saying, yes, I know this person's net worth is whatever, or their income is whatever, or you go to a third party verification site. Several of these have popped up in the last few years where they'll look at your financial statements and stuff and say, okay, we verify that you are accredited, and then you may participate in this offering. Now, the reason for this exception was that Congress, in its ultimate wisdom, decided, well, we can't really tell who is sophisticated enough or who's going to like understand the risk of a private offering. So we'll just say, well, rich people, they must have got rich somehow. that must mean that they're smart, that they can,
Yeah,
that they,
right.
that they can- that
Yeah.
they can figure this out,
Yeah,
because it was really the only sort of like bright line that they could draw to
sure.
make a definition. Otherwise, it's just impossible, right? So they
Makes
said,
sense.
and the thing is though, that income level, the test, the 200,000, individual, 300,000 as a couple, or 1 million net worth. Now, obviously in the 1930s, it was a much lower number. It's been raised over time, but it hasn't been raised since I think the 1980s,
Mm,
right? So what we've had is accredited investor creep, right? So
sure.
if you think back to the 1980s, $200,000 was a lot of income.
Yeah.
Right?
What is
Like,
that
you
today? Let's
really,
figure that out.
yeah,
Keep
you
going.
really
I'll
were
do
pretty,
the, yeah. Go ahead, sorry.
yeah, and $1 million of net worth was a lot, right?
Mhm.
Now, pretty much every first year associate at a New York City law firm is accredited, or they will be next year after they've earned the income, but their starting salary is $200,000 a year, right? So there are now many, many millions more accredited investors than there ever were before, well, which is great for for the issuers of these securities, but you can also see how this is probably driving at least some of the inflation of apartment deals, because just the market, the amount of money that can be tapped into is much, much larger. When you had probably in the 1980s, I mean, how many people made $200,000 a year? It's probably,
Well, I got the math for you. I just looked it
Yeah.
up again. One site, $200,000 in 1980 is like $665,000
Right.
today.
Right. So you're talking
Very
about,
different.
yeah, I mean, you're talking about, the top, probably what,
Half a percent.
yeah, probably not even that. If you get up to 600,000 income.
Yeah, because 1% is 412 or 420, right? Anything over 420,
Yeah.
you're in the top 1%. So
Yeah. So if you're up at 650,
yeah,
you're
that's-
probably, it's probably a lot less than that, because that
for sure. Yeah,
that asymptote. Yeah, it's like, so there were very few people to choose from
yeah,
back in 1980 who could do this. So these kinds of deals were considered, they were country club deals, right? That's what,
Mhm. That's
you
what they
really,
called
it was
yeah.
really like a couple rich, a few rich people got together and they did these deals. Now, like I said, there are entire swaths of professions where pretty much everybody is making $200,000 a year. And the pool of accredited investors is now very, very large, comparatively speaking, and that's driving a lot of what's going on. However, some people are not satisfied with tapping into accredited investors, because your friend and mine, Grant Cardone, as you were mentioning before, is now going out and raising money from non-accredited investors. And I didn't know about this. So what is he doing?
Yeah, so essentially,
that you saw.
I've seen on my social media feed, Instagram, Twitter, YouTube, he's bought a Class A top-notch building in Florida somewhere. He's now going out to folks talking about a minimum of this and minimum of that, but he will take anybody. I think the minimum investment now is $1,000, and it's open to non-accredited investors. That's the story. But I was just wondering, what is that called? Because again, he's going out to anybody that's not non-accredited.
So
and it's not B or C. I don't know what it is.
Yeah. So there is something called, I forgot to mention that. So the Rule 506 is under what's called Regulation D.
Okay.
Right?
Reg
Now,
D.
there's something,
Yeah.
there's a Reg D, these are Reg D offerings, if you hear that term, right? So it's Regulation D, Rule 506 C, B, and
Got
C.
it.
So but there was something, and honestly, like I've never paid much attention to this because it's not really relevant to me, but there is something called a Reg A offering, in which they have carved out another exception to this IPO rule for people to be able to raise essentially funds from pretty much anybody.
Right.
But there's some, there's some kind of, it's sort of, I don't know if it's an IPO light or it's something where it's just not as onerous as like a whole IPO offering, but you can raise money from anybody, and maybe you have to do it through a broker dealer.
Yeah,
I'm not really sure. But there's definitely sort of rules around how you can do this. So at some point, if people get to be, someone like Grant Cardone, where they have a huge following, they can then go and raise money from pretty much anybody they want to.
But there is that it's called a Reg A.
Right.
Okay.
However, if you think about it, if you're going to go raise money from all these people, like your administrative costs on this are going to be really huge.
Yeah.
So you have to have like a whole infrastructure just to deal with your,
Yeah.
your-
He's talking about sending payments out every 90 days. That's a lot of,
yeah.
that's a lot of work. Yeah.
Yeah. And if you think about it, like if you're going to raise $1 million, $1,000 at a time, it's 1,000 investors, right?
Yeah.
So, I mean, who wants that? Right?
Yeah.
Like,
I don't know. Yeah.
I'd rather raise it for.
Sounds like a lot of work.
Yeah. Like 20 people, at 50,000 each is even more than I really want to deal with, but I can't imagine dealing with 1,000. And then I'm sure the
phone
whoever he's
calls and all
raising,
that. Yeah.
not just that, but it's like, that's just for $1 million. If he's raising $50 million in $1,000 chunks, I mean,
Yeah. Well, if 1,000 in fairness is the minimum, I don't know what his average is, but I'm sure his average is 7, 8, 12, whatever it is, but still it's a lot of people.
yeah.
Yeah. So I guess the last thing I want to talk about this, because I got to go at 8:30, is the whole notion of accredited and non-accredited was originally created to, I don't know, protect people. Is that kind of a way
Yeah.
to say it?
Yeah. Yeah. Essentially Congress wanted to say like, hey, look, we want people to be able to raise money in these private deals, but we don't want them fleecing the widow, the
average
little
or
ladies.
yeah,
Because that was, it was like what Wall Street was doing before was
The boiler room, right?
oh yeah. And just like, going to like, fleecing little old ladies out of their savings, right? That was,
Yeah.
and
was the
telling them
thing,
they're going to
yeah.
make a mint. So they wanted to protect the little old ladies from predatory stock issuers, right?
Got it.
So, yeah.
Well, thank you very much for this. It was very educational. I learned a lot of stuff. I know the audience will. So Jonathan, thank you very much. Enjoy your week.
I will. You too. See you next
Thanks,
week.
bud. You got it.